It is never too early to invest for the future. Every investor is different with unique financial needs, but if you have government savings scheme and/or a bank account, you are by definition an investor already. Deciding on what investments to make does not need to be complicated. The financial teacher has created this guide to point out the many steps you can take to grow your savings while keeping it safe. We also identify some red flags to protect your savings from bad investments. After you understand the basics of investing, we outline the most common types of investments, including shares, managed funds, and property. Warning: this guide is informational only. The financial teacher does not offer any investment advice, guidance, or any opinion on investment options. Investing: the basics. Investing is best defined by billionaire investor Warren Buffett, who defines it as the process of laying out money now to receive more money in the future. Ultimately, people make investments intending to end up with more money than they contributed. For example, buying a house for $500,000 and selling it later for $1 million is just as valid an investment as buying shares in Zero for $1 and selling them for $40. For most people, investing is really about having your money work for you over time without worrying about it. 1. Set money aside so you work smarter, not harder. Most of us work long and hard at our job, whether for a company or our own business, saving a portion of our hard-earned money and putting it aside. If done correctly, our investment grows over time. As our money works for us, working less becomes an option as our savings build up. For example, if you reach 60 and have $500,000 in savings, a 5% annual return is the same as a $25,000 income. This can make a huge difference if you want to spend your time on other things. 2. Investing does have drawbacks. You can't spend frivolously. Investing money means the same money cannot be spent on things that make us happy, such as holidays, new clothes, and eating out. However, balancing spending with saving is not as hard as it sounds. You just need to work out what you can afford and stick to it. In the long term, your investments will hopefully grow in value, giving you more financial freedom and the ability to have more money in the future without necessarily working. Investing is primarily a means to a happier life in the future. 3. Understand risk versus reward and select the right investments. Investing has a degree of risk, and the old saying of high risk, high reward generally applies to the investment market. To avoid investments that don't deliver what you expected, you'll need to start by deciding what you want to achieve with the money you set aside. Once decided, you will have an investment strategy you can use to make the most appropriate choices. 4. Deciding on an investment strategy up front makes for better investing. Successful investors have two things in common: they are clear and realistic about what they want to achieve, and they research where their money goes and make sure they understand how it works. Anyone who blindly hands over money to something that sounds like a winner without doing their research is risking their money. Think about financial goals, like saving for a car, buying a house, or saving for retirement. It helps to ask, what goal will investing help me achieve? Understand the basics of different types of investments before choosing an investment. It is essential to know what the different types of investment options are. Once you have an idea about the choices available, you can decide which ones are right for your investing goals. Bank deposits and term deposits. This is where you invest a sum of money with your bank and earn interest, the return, for a fixed period. For example, a bank offering 4.99% per year for 12 months, meaning that the bank a return of 4.99% per year on your money, is an example of a term deposit, whereas an offer of 2.00% on balances above $500 is an example of a bank deposit. The bank pays you interest on money you keep in your account above $500. For example, interest can be paid monthly, quarterly, or annually. Bonds. This is where you loan your money to a company who provides you with a fixed return, which is usually but not always higher than what a typical bank offers. For example, you can buy bonds in companies you know who may offer a return of 5.50% per year for 2 years, meaning every year the company pays you 5.50% of your investment balance. Property. Buying houses is a long-standing investor favorite. The process is simple. You buy a property with two goals in mind: renting it to pay the mortgage and/or provide an income, and anticipating an increase of value over the time you own it. Most investor mortgages now require 35% or 40% of the price of the house up front, but not always, and the rates of returns differ depending on the property type and location. Shares: when you buy a share, you buy a piece of a company. The more you buy, the more of the company you own. Investors buy shares believing the price will go up in time and/or that the dividend cash return on the share is attractive. Shares are not without their risks. The price can go up and down every day, and in a given week your investment may fall in value, but you don't make or lose any actual money until you sell your shares. Government-run retirement savings scheme. It operates to allow you and your employer to contribute to an investment with the aim of building a nest egg sum of money for your retirement. Peer-to-peer investments. This is a recently launched type of investment where you lend to a platform who lends your money directly to borrowers. The idea is that you get a higher return than that offered by banks, while the platform carefully assesses whether borrowers can repay before lending out your money. Finance companies. These are private companies, and they work by lending your money to borrowers, usually in the form of short-term loans. Finance companies pay you a return on your money, for example 9.00% per year, with a minimum investment of 2 years. Once the 2 years is up, you can reinvest the money or withdraw it. Finance companies were in the news a lot during the 2008 financial crisis due to many of them going bankrupt because of borrowers not repaying their loans. Managed funds. These investments come in many forms. The basics are the same. You buy units in a fund, which is made up of many underlying investments. For example, a managed fund may be comprised of 1,000 shares, and so your investment is spread over these shares. The overall performance of the managed fund, that is the gain, depends on the performance of all of the investments that comprise your fund. Managed funds usually charge annual fees to operate, which can range from 0.10% to 5.00% of the value of your investment. There may also be entry and exit fees, so for these reasons, managed funds often form part of a long-term investment strategy. A business or venture. This could be a startup or buying into an existing operation. This type of investment could be passive, that is, you don't need to do anything, or active, that is, you work in the business. Whatever the nature, this is usually an investment with high risk. For this reason, understanding all of the details about the business before you invest is really important. Businesses can become money vacuums, and you may be required to invest more than you originally planned to keep it going in the short term. Other investments we haven't mentioned: investments such as cryptocurrency, that is Bitcoin, gold and precious metals, futures, and similar platform trading. We believe these are best avoided by the average investor looking to invest in their future.